Yeah, a great example of capital gains tax through an estate is when you have non-resident beneficiaries. Now, effectively what happens, if you're a non-resident, you fall out of the capital gains tax system. You don't pay tax on your share profits in Australia if you're living outside of Australia. If you have an estate that then passes assets to a non-resident, effectively the government says, well, we're going to lose these assets out of the system. We're going to take our tax dollars effectively on the day you die. So you can have a will that's drawn up. Say, for example, you have 3 resident beneficiaries and 1 non-resident beneficiary. Now, if the assets get split quarter by quarter by quarter by quarter, you give that quarter to the non-resident. What happens then is that you've actually triggered a capital gains tax event back on the day you die. So if you have to pay tax on that capital gains tax event, it's essentially every beneficiary wears the tax for that one beneficiary, because it's a tax on the estate. So what we're now seeing in wills is that people are putting specific clauses into their will to actually allocate tax if they have in mind that there's a non-resident beneficiary, because if there's nothing, the tax is borne by everybody. But if you have this clause in your will, it's that particular beneficiary that reduces their entitlement, for want of a better word. So that's what we're seeing. It's probably a great example. I know if I was doing my will right now, I wouldn't know if my beneficiaries were going to be living overseas by the time I passed away. So therefore, I would say this particular clause should be a standard clause in all wills, just for beneficiary